We're half an hour away from the opens in Hong Kong, Shanghai and Shenzhen. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Let's get to your top stories today. Stocks across the Asia-Pacific gaining as traders boosting their bets on a December Fed rate cut following a subdued U.S. inflation report.
Republicans securing a sweep of the White House and Congress as Donald Trump announces more cabinet picks, including Matt Gaetz for Attorney General.
Plus, Tencent reports a 47% profit surge driven by games, while payments transactions signal a tentative economic recovery in China.
Right, quick look at the market action this morning. What we're tracking so far in Asia is actually what's happening in Korea. I'm going to start off here. It's a little bit unusual, yes, but to note, we've got Korean markets just coming online this morning. It's 1 hour later today because it's college entrance exams day, so spare a thought for those students over in Korea. 8 hours of back-to-back exams. The markets always come online this day, 1 hour later. We have really seen that market as well, being the biggest expression perhaps in Asia, aside from China, given these concerns around Trump's America First policy. What exactly does that mean? It was the biggest laggard yesterday in the session. Today, they were moving just a little bit higher so far. And that's really the other side of the story that came through because, of course, Korea highly correlated to what happens in the US. We did see US stocks futures here steady, but pushing higher above that 6,000 mark on the S&P 500, given what came through with the US inflation print. Pretty much in line with estimates. We actually saw it at headline, again, meeting what economists had been saying ahead of it, but it tells us that inflation, it's going to be sticky on the way down. And so that Fed expectation, yesterday morning, we were looking around a 56% chance of a cut in December with swaps traders. Today, you're looking at odds of around 80% chance of that happening. Let's change on, take a look at how the market has really reacted to that. We have seen JGB yields moving. We'll get David to get that reaction in just a moment. But the yen here, fairly steady so far against the greenback, just a little bit weaker. But we did see yields as well today, fairly steady again. We did see them moving higher at the front end of the curve, not seeing that reaction really coming through in Asia. To note as well, we do continue to track what's happening in the crypto space, and let's just take a quick look if you change on what's happening in Bitcoin this morning, above 93,000, and lots of people out there are saying 100K, that's the next line, back down to that 90% or 90,000 mark right now, but still certainly something to be tracking very closely. Chinese futures, meanwhile, pointing to a drop here. Really coming into the week again, that concerns around what does the Trump election mean? Could we have been saved by some sort of strong earnings coming through from China tech? Well, Dave, that's really also been something that's been disappointing overnight because we had Tencent figures out. Yes, we saw strong numbers on the top line, but you drill down and you see that concern coming through in the fintech, the advertising businesses. Games growth is petering out. We saw Tencent dropping in ADRs, and it doesn't really bode that well for market trading in the session today.
Yeah, I think we were down 1% in the overnight session. But yeah, I mean, you can really tell when you look at these earnings coming through that, yes, there was a pickup. Yes, there was a beat. There are questions, to your point there, Bill, on the underlying strength, and, as a reflection of the economy because, of course, of their presence across, payments and transactions. More on the Tencent story, of course, in a moment. To Bill's other point, too, on the Japanese yield story, not on your screens, though, is the 30-year yield in Japan, bottom right now, 2.3%. Actually now at the highest since 2010. So a lot of the conversations around, is a central bank going to be able to cut rates? The question now for the BOJ, looking at the pricing, swaps are now indicating a full hike before the end of the fiscal year in March, possibly a move out of the BOJ in December. We'll certainly see one. We'll see. Certainly the consensus is they'll probably move in January. More in the weak yen story, which is continuing to give. That takes us into the broader market story, the strong dollar, this pullback in gold, this pullback in Asian equity markets. India entered a correction yesterday. The Philippines entered a correction yesterday. The Hang Seng Index at 19.9 right now on the index basically takes that specific index back to levels of the week of the PBOC briefing in late September. We haven't quite retraced all the gains, but we're certainly extremely close, or the closest we've been since the rally actually started. Weather updates out of Hong Kong, of course. We mentioned this. We are under a T8 signal right now in about an hour and 15 minutes. We understand that the officials are going to lower that to a T3. The reason that is significant is we will get trading today nonetheless. First one under a T8 scenario. Earnings coming through today very, very quickly. Let's have a look. See Bilibili, Geely, JD.com, NetEase among the companies reporting earnings. And to wrap things up at the end, towards the end of the week, of course, is Alibaba. So, yeah, just to get you through some of the key points, of course, as we make our way into Thursday.
Yeah, it's really that sort of two different themes. Again, we keep talking about this, but on the one hand, you've got China, you've got those tech numbers that are coming out, and the other hand really just continues to be around inflation figures, and that was sort of the headline data point for the week, you could say, because it was going to set the direction of what the Fed could do, and would we see that cut in December? As I was just saying, we had many, at least in swaps pricing, we're seeing, you know, maybe we won't have such a big chance of a reduction at the end of the year. Even next year, you think about people were talking about 4 cuts at the start of this week. Now you're around that 2 mark instead. But still, the inflation numbers gave people some good news, I guess, because it tells us, yes, maybe there is a reduction ahead. Yeah, there was no nasty surprise coming through, right? So long as the data did sort of cooperate as far as the Fed and expectations go, they might be able to move, which is probably where pricing is right now. 80% probability that the Fed will cut interest rates over in December. In fact, we did hear, I believe, from Minneapolis president.
A fairly important guy.
A very big one, because of course there's been a lot of Fed officials talking across the course of this week, but really some different views coming through on how far they can go in lowering interest rates. But let's just listen to what Kashkari told us.
I'm not seeing a lot of upside risk yet. We don't know what's going to get enacted. I'm not seeing a lot of upside risk that inflation is going to take off from here. The bigger risk that I'd be concerned about on the inflation front is just if we're landing at around the 2.5% level instead of back down to 2% level. I think that those risks existed before the election, and I think that there continues to be uncertainty now, and we need to just take our time, let the data come to us, and let that guide us.
Right. Now, on the macro and the markets front, let's take it straight back to Singapore, where the annual Barclays Asia Forum is underway and drawing, of course, global business leaders, policymakers. Joining us now from the event is Kaanhari Singh, head of Asia Cross-Asset Strategy at Barclays. Good morning, and thanks for joining us and making time. Let's get straight to it. I mean, we've seen a pullback in Asian equity markets this week. We talked about India entering a correction. Several parts of the market have been under pressure. I'll try and ask a question that might not have a definitive answer. How long do you think U.S. exceptionalism can continue to weigh on markets as part of the world, Kaanhari?
Yeah, absolutely. Morning, both, and thanks for having me on. Look, from our perspective, in terms of what's going to shape investment strategy in Asia into 2025, it really feels like Asia is going to be a bit of a price taker in terms of the broad themes that are going to drive markets here. And what I really mean by that is that, the biggest drivers here really are what happens after the U.S. elections in terms of, as you said, U.S. exceptionalism. And there we continue to see that play out because really U.S. exceptionalism was not as much, hinging on the U.S. elections as it was a structural theme that gets supercharged because of Trump 2.0. And then the Fed outlook, and then, of course, in the region, the biggest driver is going to be what China stimulus, how that plays out, and how big and sustainable it really will be. The way we think about investment strategy in this broader framework and what that means for markets, the release valve of all of this together for now is really going to be broad dollar higher. And that will probably be the channel that impacts Asia, at least in the medium term. And then, we can talk about geopolitical bifurcation, tariffs, but that's something that comes next year. For now, the broad dollar higher theme is really what's been driving risk in the region across FX and equities. And we see that continuing. We're looking at euro at 1.04. We think dollar CNY goes to 735 and then 750 by end of next year. Dollar yen, we think, goes to 158 before settling in again around 155 levels by end of next year. So for now, U.S. exceptionalism continues from our perspective, and the broad dollar higher channel impacts Asia immediately.
Yeah, and we're certainly seeing that. We were just showing a chart earlier, the pullback that we're seeing in a lot of non-U.S. markets, essentially. When do you think we sort of get a semblance of calm then restored to the market, and what would be the driver of that?
Yeah, look, I think China's stimulus is a really big one, right? And the way we are thinking about that, top-down at least, is that domestically policy matters quite a lot, and the impact of policies announced so far is crucial, not just for domestic assets, but also for regional assets, to put a floor under under the sell-off that we've seen. The downside to that, though, is that even though markets got ahead of themselves after the PBOC presser in September and the end September surprise Politburo meeting that you had, it looks like what the NPC is telling us last week is that for now, the focus from a policy perspective is very much, strongly on curtailing the left tail risk, but not necessarily looking for a large re-acceleration of growth. And that matters because it's likely that, China's fiscal stimulus could be reactive as opposed to proactive, especially to China, to any tariffs that might be imposed on China next year. And that will eventually help regional risk in the region, but we just think that it's more of a March NPC and after story as opposed to right now.
Yeah, I was about to ask you what the appropriate exposure to China would be, 7 or 8 weeks since that policy pivot.
Yeah, look, we went long China equities versus short India equities mid-September before the policy announcements started coming out. And the view there was that we are likely to see more policy stimulus. There was a pretty strong but subtle pivot on stock market support in mid-September already before the PBOC presser happened. And then the valuation gap between China and India was back at historical standard deviations, and it seemed like sort of a no-brainer trade really heading into the fourth quarter, especially if you were going to get a global value rally. That is risk that we still like. We think it has more room to go, especially into year-end. And it's been a trade that's working on the equity side on both legs. While China has been stimulating, India's growth has been seeing a little bit of a cyclical slowdown. We know that foreign investors were very heavily overweight in India within their broader EM portfolio. And some of those outflows we've already seen pick up quite strongly in the last 4 weeks. But we think that continues into year-end.
Just on that topic of India, because you are at this event to talk about India's outlook post the election, whether it's going to be reeling or resurgent. That's actually the title of your panel. But talk us through the views that you're planning to share.
Yeah, absolutely. Look, the kind of medium-term view on India that we have is that it's still an economy that's seen spectacular economic growth in the last 2 years, and especially in the broader EM context, we don't see that changing. But there is a cyclical slowdown that's happening in India right now, and it's been quite evident in the broad high-frequency indicators that we track, be it on the consumption side, like personal credit growth, or be it on the investment side, indices that track steel and cement output. And what's been interesting is that even though the slowdown has been happening since June, foreign investors were willing to overlook some of the red flags on growth or on earnings. And that's because India, benefits from there is no alternative, a TINA phenomenon in the global EM portfolios. But with China starting to stimulate, there is now an alternative that EM investors can be looking at, especially for 2025. So the cyclical slowdown is something that we're going to dig into. It's definitely catching up to markets in terms of valuations. The second thing that we are going to discuss, which I think is quite important, is that even though you see foreign outflows from India and the stock market, it's not necessarily indicative of a big correction in the domestic equity markets, because the structural theme that's been playing out in India since COVID has been this financialization of household Indian wealth, and the amount of kind of domestic inflows that you see persistently going into equities. And that's something we're going to touch upon as well. Like, how do you really think about that in terms of foreign outflows and then earnings finally starting to see some sort of a growth, some sort of a slowdown in momentum as well?
Kaanhari, final question. I think we started the conversation. You mentioned we're price takers this part of the world because of the strong dollar. What else is your wild card? What causes the pain trade next year? What should I be watching out for if it isn't the dollar?
Look, the pain trade is not on the FX side. On the equity side, the pain trade is still China equities higher by a large margin. And we saw snippets of that, in September with how aggressive those moves were. And I don't discount that going into the March NPC again. The December Central Economic Work Conference, slightly less so because we are probably not going to get firm numbers around the fiscal deficit target. But going into the March NPC, I don't discount that you might see another sharp, aggressive rally higher in China equities. But on the FX side, though, David, I will make this point. With where dollar yen is currently around 155, it clearly forces the BOJ's hand to do more rather than less in terms of rate hikes. And I think that is quite important, right? Because we saw the impact of that across assets, not just in FX over the summer with the carry trade unwind. And we're not saying that's going to happen again for a variety of reasons. Positioning is obviously a lot clearer now, but that's a risk to look at, and that's not something that markets are discounting right now, at least in broader assets.
Yeah, absolutely. I mean, there's certainly big questions over where the carry trade goes next year. But Kaanhari Singh, we're really looking forward to having you back on our shows again sometime soon. That was the head of Asia cross-asset strategy at Barclays there. And actually just still in the FX space, we've just had the Yuan reference rate coming out. A little bit stronger fix in the estimate here, so it's another signal to us that the PBOC maybe getting a little bit uneasy about the drop. We did have that sort of appreciation building that they would be comfortable with allowing a weakening yuan as sort of a buffer against this tariff risk. But now maybe a few more question marks over that. So the fix coming in 7.1966 per US dollar.
Yeah, 360 pips stronger than estimates. As you can see, dollar China is down. Going into the opening bell, 12 minutes away, and of course ahead, 24 hours ahead of that crucial data dump, which comes out, of course, towards Friday. More ahead also from the Barclays Asia Forum. We'll be joined by the co-head of investment banking, Taylor Wright, joins us later this hour. We'll also be speaking with the bank presidents, Dainton and Rockefeller. International Chairman Ruchir Sharma joining us, of course, on those times on your screens. Counting down to the open of trade, 12 minutes away in Shanghai, in Shenzhen. And yes, we do have market trading here in Hong Kong on this T8 Thursday morning. This is the China Show.
Republicans have held on to their narrow majority in the US House, giving Trump and his party unified control of the elected branches of government. Bloomberg managing editor Derek Wallbank is with us. And Derek, I do definitely want to get to some of his picks that he's made in the last few hours in just a moment. But let's start about what this sort of sweep means for the Republicans, because it definitely does seem to give them a bit more control and strength in their hand. But at the same time, they could be leaving themselves open to some divisions as well.
Well, Annabelle, I think that's exactly right. Look, Republicans are going to control the presidency, the House, and the Senate, and they already have 6 out of 9 seats on the Supreme Court being appointed by a Republican president. And so Donald Trump is going to have, as president when he takes over in January, a pretty clear run to be able to do a lot of the things that he wants, right? The House control got called overnight our time by U.S. TV networks. And what that really means is kind of in two things. One, it's a lot easier for Trump to proceed with how he wants to on tax policy. And the second is maybe a more subtle thing, but it goes to the issue of guardrails and constraints, is that Trump won't have adverse lawmakers leading committees that could run investigations into his White House. They'll all be held by Republican lawmakers who are, in pretty much every case that we can see right now, a lot more favorable to the president.
Okay, well, do any specific names stand out to you, Derek, at this point in time from, I guess, 12 hours back? We have a couple of fresh news that just came out, of course.
Well, look, I think the big one that everyone's going to be focused on is Matt Gaetz for Attorney General, right? Matt Gaetz is a firebrand from North Florida. He has been a big Trump fan, but there's a lot of people in Congress who don't like him at all. I mean, at top of that list would have been former House Speaker Kevin McCarthy, who we had on our air in the last hour. Right, but Gaetz has a lot of interesting questions about this appointment, starting with, and yes, there is a high level of deference, but I think one of the first questions is, can he get confirmed? Lisa Murkowski, the Republican senator from Alaska, said that this wasn't a serious pick, and we have seen some skeptical comments from other senators who will have to have to go look at whether or not to vote for him. Now, Gaetz has said that he's going to resign from Congress, resign from the House in anticipation of this. There is now a new question. The House Ethics Committee had been looking into him across a number of issues. There's some questions about whether or not that report will get released at all and what that might say if and when. So that is one, I think, that has engendered a lot of question. I do think that there's a through line, though, running through a lot of Trump's picks on loyalty to the president. This is not a group of people who may or may not go away from him. This is a group of people who have been loyal to him far more than maybe ideological sameness, right? And you can see this in some of the national security picks. But one thing I do think that runs through, and it's important, to discuss as we're, on a China show, is that there is a very strong through line across the national security picks of people who are seen as quite tough on China, from Marco Rubio, the choice for Secretary of State, who is actually sanctioned by China, to Elise Stefanik, the UN ambassador nominee.
Derek, thank you so much. Derek Wallbank, our managing editor in Singapore for us. Going into the open today, 5 minutes away, we're called lower on Hang Seng and Hang Seng China Index. The Hang Seng China Index set to open at a 6-week low near the 7,000 level. We're back there again. Yes, we are. Plenty more ahead. This is Bloomberg.
Couple of minutes away from the start of trade, keeping an eye on tech stocks. Tencent, we had those earnings out. Game sales impressing, but certainly the fintech arm a concern. Other earnings on the docket today you can see there. Let's shift on quickly, take a look at property stocks as well, because China has been cutting taxes for home purchases. That's, and again, another fiscal policy support push, and you are seeing those stocks looking to open higher. The open is next. This is Bloomberg. Welcome back. You're watching the China show, and we're counting down to the open of markets. And Dave, I was actually just taking a quick look. I mean, I think we're getting pretty used to seeing red across the screen for Chinese equities, and today is really looking to be no exception here. We've just had a quick check on those property stocks. They were moving higher with some easing of home buying restrictions, but it's really that negative sentiment, and it's come through again in the earnings. For instance, Tencent, one of the notable ones overnight, but there's really not enough to prop up sentiment, it seems.
No, and it's interestingly, it's fitting that we had that live shot, for people familiar with Hong Kong, live shot of the peak. And it's certainly the view right now when you look back at markets, you're sitting on the other side of a chart and looking back up the peak. at some of these equity markets, right? So we're set to open at a 6-week low in Hong Kong. We're at very precarious levels. I'll get to the specific level in a moment here. We were down about 100 points on A50 futures. We have a bond sale coming through today. Central government bonds. You have, I think that's a 3 and a 7-year coming through today. On top of the pricing, which we'll get more on the dollar bonds, which effectively China's effectively paying now. I think it's 1 basis point above treasuries for similar duration fixed income, 0.3% to the downside. We have opened below the 4,100 level on the CSI 300. A pullback, as you can see, in copper and iron ore, for example, is pulling back a little bit. This is a day, of course, ahead of the activity numbers, which are set to come out tomorrow. Very, very quickly, let's have a look at Hong Kong, please. It's really where you're seeing the sharper pullback, relatively speaking. So we're down about 1.3% on the Hang Seng Tech Index. We're now closer to 7,000, down about 1% on the Hang Seng China Index. We're under, speaking of the weather, T3 right now, T8 right now, T3, so that takes it back to a lower typhoon signal level in about an hour or so. So in other words, make your way to work or get ready, if not already. We are opening lower. Okay, a couple of other things I want to note here. So you have some movers to tell you about. You have Tencent, obviously, here down about 1%. We'll talk more about and really unpack those earnings in a moment here. Interestingly, we've been talking about U.S. politics, right? Tariffs, the threat of tariffs. Where do companies, and change the page, please, where do companies then sort of place some of their production capacity to get around maybe some of the tariffs right now? So interesting, well, related but unrelated pieces of news here. So on CATL, Reuters reporting that the company can consider putting up a U.S. plant if they are allowed to. That's number one. Number two, BYD, this planned plant in Mexico. So they've narrowed down, I believe, the number of potential locations for that. They'll announce that quite soon, I believe, based on what the company's spokespersons have come out and said in the last couple of hours or so. Earnings story out of Geely today, and of course we're looking at Hong Kong exchanges simply on the back of us. We're trading today, of course, despite the typhoon signal. Okay, as promised, very, very quickly, Hang Seng Index, we took out a support level 2 or 3 days ago, which was really, we filled that gap to the downside, which was effectively the high point back in September. I think this is September 27. And the reason this is important and where we are right now is it takes you all the way back. And that was the day that the PBOC had the press briefing. We took that live. They had a big announcement. It marked this, the policy turn. And you know what? We're very close to retracing back to those levels. It's still a couple of percentage points. But again, these markets are, I guess, in many ways have a higher bar of expectations here, Bill. And I think the earnings story on Tencent, which actually reported a nearly 50% pump in profits, and the stock is down 1% in the early goings, Bill.
Yeah, I think the only consolation probably we've got so far in Tencent is that the drop that we're seeing in Hong Kong is not as much as we have for the ADRs, which were down nearly 2% overnight. But the story today really around Tencent, as you said, yes, at the sort of headline level, we saw that big profit jump, a 47% increase. And that was really driven by the video game division because it's been that story of the China gaming renaissance, but concerns about other parts of the business as well. So let's get more on that now and bring in our Asia Tech editor, Edwin Chan. And Edwin, really that's the story. I mean, on the one hand, you've got, yes, good games. Bad, though, is fintech and the advertising business, it seems.
That's right. I think the market had expected a good gaming performance. This summer, we saw some of the most successful games that China has seen in a long time. So I think that was already factored into the share price. Now, on last night's call, executives kind of gave a mixed picture of the economy. I think they outlined early signs of consumption pickup in terms of payments transactions over their platform, and that had followed months of successive decline. So I think there was reason for optimism there. But at the same time, the fintech business that kind of is one of the best indicators of macroeconomic environmental factors. It's been slowing for quite a while, and it managed anemic growth. I think it was something like 2%. And so a lot of investors kind of seized on that. And also, very importantly, the commentary from Tencent's top executives was not exactly super reassuring. I think, they were talking a lot about how long-term fundamentals gave investors reason for optimism. but they stressed several times, in fact, that any pickup would be gradual and it'll take time for policy stimulus to kick in, as it were.
Yeah, I was about to ask you too, like compared to, and we'll get Alibaba, I think, tomorrow, compared to their other peers in the Chinese tech complex, is Tencent in the best position to take advantage of any potential pickup in the economy moving forward because of its sort of unique business footprint?
I think that's the market consensus. It's not so much that they're best positioned. I think it's that they're less exposed to some of the weaker segments of the Chinese economy, most notably consumer confidence, consumer spending. Alibaba tomorrow and JD tonight, I think, are heavily exposed to that segment of the economy, which in some ways is most worrying because China's trying to rebalance GDP growth, as it were, towards consumption. But it'd be interesting. We'll be looking out for JD's commentary tonight.
Yeah. All right. Clearly, the glass is half empty for Edwin Chan. Banter there, of course. Edwin Chan there, our Asia Tech editor. Right. Let's get to the bond story in China. So they sold $2 billion in bonds. I think it was 20x in terms of demand. What was on offer here? First bond sale, dollar bond sale, in about 3 years or so. To get us the details on why we saw substantial demand, what the pricing was, Loretta Chen, our China credit reporter, is here with us to talk us through this. And yeah, what do you make of this? $40 billion in bids for $2 billion in notes. How much should we read into that as far as underlying demand is concerned?
Yeah, well, this is certainly a very wildly popular deal for the global investors. What's special about this bond is that a week ago, the Chinese officials announced that it's planning to sell this bond in Riyadh, Saudi Arabia. So it's really targeting a lot of the investors in the Middle East, amid these deepening ties between the two regions. So we haven't really seen the book stats of this bond, but we can, confidently say that we're going to see more allocations to investors coming from the Middle East. And another part of that story is the strong demand coming from onshore Chinese investors, with a play that they can do with, currency arbitrage. I think they are also benefiting from getting some yield pickup in the offshore market, just because, at the same time, onshore market, we've been seeing, a lot of tightening, and just yields on government bonds have been dropping a lot. So it's a mix of demand coming from the Middle East, which the Chinese government has been trying to attract, plus the strong demand coming from onshore investors looking for yield, that we have these 40 billion bids. And I think we'll have more details about, who are actually looking into investing in these bonds.
Yeah, Loretta, I was going to ask you, we're showing a graphic of U.S. yields right now. Effectively, I think what we're trying to get to is you're effectively priced at treasuries. And does this indicate strong demand for Chinese government bonds at U.S. yields?
Yeah, so I think also the question that investors are probably asking themselves is, are they willing to, take the Chinese government bond exposure at, practically the same price as the U.S. Treasury? And I think in this instance, I think if you're really looking at a very selective kind of investor pool, a mix of these onshore Chinese investors, mostly banks, plus, the Middle East investors, and I think in a way that Middle East bond sale is largely symbolic. It's really about, the rhetoric about deepening ties between the two regions. Then I think that's what gives so much, special demand to this particular bond. And then, of course, on the other hand, in the secondary market, actually a lot of the Chinese dollar bonds have been trading below Treasury yield for the most part of this year. And again, due to the strong demand coming from onshore investors looking for yield.
So what's sort of the longer term game here then, Loretta? Are we talking about China looking to issue more dollar denominated debt in the Middle East, or do you think this is sort of paving the way to get investors familiar with that concept and then maybe issue in Yuan denominated debt instead?
Yeah, I think the dollar debt that China is selling now, it's also, the first that they've been doing that for 3 years. And I think for the next 12 to 18 months, China will still have less incentive to sell a lot of dollar debt because onshore yields have been so cheap, and they could just sell the bulk of that in the onshore market. But I think it could selectively pick the market where it wants to target certain investors to sell these not just dollar but also other foreign currency debt. So we saw China sold 2 billion euros in Paris. That again could be part of that story of the political rhetoric, the deepening ties that China's trying to play. So I think for the next 12 to 18 months, we could continue to see those smaller size type of bond sale just happening in selective regions, and I think that's not mainly due to really the price incentive, but really about the investors that China is trying to attract.
Loretta, thank you. Loretta Chen there on this China's first dollar bond sale in 3 years' time. A couple of markets coming online this hour. Just a brief look at equity markets and the Kospi Index opening an hour later because of college entrance exams. The other market we're tracking too is the Philippines, which entered a correction yesterday and, as you can see, is falling deeper into that. And of course, we're watching India, which opens up later today. That market also entered into a correction on Wednesday. This is Bloomberg.
Let's head back to the Barclays Asia Forum in Singapore. Bloomberg Insight anchor Haslindra Min is there with our next guest. Huge lineup has across the whole day.
That's right. Huge lineup, and we're pretty excited. Joining us now is Taylor Wright, Global Co-Head of Investment Banking at Barclays. Thank you so much for joining us. We know that since you took over, I think in 2023, you've embarked on this restructuring of the business. Take us through where you are right now and where you're headed.
Sure. Well, first, thank you for having me, Haslinda. It's great to be here, and it's great to have you here at BAF, broadcasting from the conference. So thank you for having me. Sure. Just in terms of the business itself, look, Colin and I have been running the business for a little over a year and a half now. What we found in the business is a global full-service platform where we can serve clients in the regions where they want to be with the services and products that they want to have. And so what we embarked on, and we talked about this in our Investor Day in October, is a strategy that would support the group strategy of boosting returns and delivering more for clients. So for investment banking, we're focused on certain sectors in terms of investment. We've made that investment, largely made that investment. And we've implemented, three principal strategies in the business. One is something that we call treasury coverage, which is really a focus on covering the treasury functions at our clients to deliver more products and services to them. Two is delivering and growing our M&A and ECM wallet share with both sponsors and corporate clients. And then the fourth is just a capital stewardship mentality, where we're sort of allocating our human, intellectual, and capital resources more deliberately across the client set.
You've made big hires, and some say that those big hires should be delivering. When do you expect that to make an impact?
Look, I mean, strategic bankers take time to season on a platform. We hired about 40 people, 40 MDs last year. We hired no more than 20 this year. We hired them specifically in coverage sectors and in product areas like ECM and equity. We are absolutely seeing some of those bankers start to produce. But what we really like about what they're doing is how they've integrated into the teams, how they've engaged with clients in a positive way, and the activity that we're seeing with those clients gives us real confidence around their ability to deliver over time.
And speaking of activity, people say that activity will pick up. Do you expect that you'll need more hires in the coming 12, 24 months, perhaps?
Look, we feel like we've got a great team. We have a couple of hires that we probably need to do globally over the next year or so. But the predominance, and we said this in the Investor Day, we have most of the hires that we plan to make already in the building. And that's a great place to be because now we can focus on execution.
Let's talk about the outlook for deal making. Every single year, you hear everybody saying that it's going to be a better year. It hasn't been. When do you see that ramping up?
Well, it actually has been a better year. It may not feel like a better year.
The second half of this year, the first half didn't look too good.
Well, last year, the investment banking wallet was about $67 billion. This year, it's running at about $80. That's about what it was before COVID. Now, market caps have expanded, so you could argue on a cap-adjusted basis, it's still not back, but it's up about 20% from last year, so that's encouraging. It's also been, the activity increase has been across the board. It's been driven by capital markets, but we've also seen M&A activity pick up. And so we would say that this year has been a better year, and we see improvement. We expect further improvement next year, and we can get into the drivers of that. But we think next year is going to be a better year. We like the next 12 to 24 months, in fact.
How much better and why? Some say perhaps, there's an easing environment in terms of regulation and technology, especially. I mean, that's the indication from the Trump administration, for instance. Might that be driving sentiment?
That's probably part of it, but it's more if you look at the backdrop. You have equity markets at or near all-time highs. Volatility is quite low. You have rates and spreads at levels that are conducive to supporting an active financing market. We've absolutely seen that this year. You've seen sponsors actually start to come back into the market. The sponsor participation in equity financings, debt financings, and M&A has been the missing piece. And you're starting to see increased confidence in C-suites and boardrooms around strategic transactions. So all those things are actually conducive to more activity going forward.
Buyer's market, seller's market?
I think it depends on the asset class, honestly, and the type of transaction you're looking to do. We think next year you're going to see a lot more IPOs, as an example. And so that's a staged disposition, right? You're taking a company public, and then over time you're monetizing it. But both the clients that we talk to on the buy side, they're very much expecting it. They're very much set up for it. And the owners of assets, particularly scale assets, are absolutely preparing to tap that market.
So which are the growth markets? You talk about the IPO market. We've seen a very healthy IPO market in India, for instance. I mean, what expectations are there for Asia, and how big might these IPOs be? What are you looking at?
Yeah, look, I mean, the biggest IPOs will be in the U.S. That's the biggest market there is, right? So you're going to see companies that are tens of billions of market cap go public. Those are multi-billion-dollar IPOs. In Asia, you also have some large companies. The Indian IPO market, as you point out, has been quite active. Look, I think it really is going to depend on the asset class, because you ask buyer versus seller market. Actually, what the buyers want is quality assets, particularly when it comes to IPOs. Their challenge has been that IPO activity has been episodic, and the performance has been inconsistent. And so to have a functioning IPO market, what you need is high-quality product, deals to work, and that will allow more companies to come
And the
public.
right valuation, and right now everything is looking so frothy. What's the risk for the market?
Yeah, look, again, I think valuations have rallied in certain sectors, in particular tech. They're still off of their peaks, but they've come back. And so you're probably at that equilibrium point where buyers and sellers can each agree that it's a reasonable place to start the conversation, and that's a good spot to be for the IPO market.
Let's talk about the private market, because some say there's a convergence between private and public. What opportunities do you see?
And by private market, you're talking about private credit, right?
Yes.
So private credit absolutely is part of the ecosystem. We have a collaboration with AGL in the U.S. for private credit.
And that's going along well?
That's going well. And really what we want to do, and I think what our competitors are doing, who are doing something similar, is what we want to do is we focus on the client, right? We don't have, we need to be market agnostic, and we're trying to be solutions providers. So what we want to be able to do for our clients is provide a private and a public credit solution, if that's what their challenge is. And we want to be able to deliver consistently for them.
All right, Taylor, good to have you with us. Taylor Wright, Global Co-Head of Investment Banking at Barclays. We've been coming to you live, and we'll continue throughout the rest of the day. For now, though, Dave, handing it back to you.
All right, Haz, great stuff. We'll let you regroup and revisit there in a couple of minutes. Coming up in the next hour, also from where Haz is at Barclays Asia Forum, are the bank's president and the head of investment banking, along with Ruchir Sharma, of course. There we go. Lots to talk about. Still lots of good conversations just ahead. And this is just in the next hour. There's more coming through after that as well. Very, very briefly, there's a headline coming through here on copper prices. We're flirting, Bell, with a specific whole number here.
Yeah, that's right. below they slid below 9,000 a ton. You're trading around that mark, but certainly we're seeing metals really reacting to the strong dollar story and that weakness around what's happening in China. And you're seeing that drop there over 5 days, down nearly 7%. We'll have more ahead. This is Bloomberg. Quick check on markets this morning, and certainly it's still very much trained on the Trump trades across markets, and Bitcoin has been one of the biggest expressions of that. We briefly topped 93,000 a token overnight, but we are still seeing it moving a little higher in the session so far. And in Asia, it's been that story across the week of these crypto-linked stocks, Huobi, for instance, one of those, but really just continuing to move high. So that's anticipation that we're going to see more rules coming in place in the US for the sector. With that clarity, it leads to institutional adoption, and that leads to the asset class becoming more mainstream, Dave.
And this is really for people that didn't think there was a Trump trade to be made in China, a long Trump trade. These are some of the names there, including, Meitu and Huobi. Wuri, of course, is listed in South Korea. Yeah, there we go. Tencent is also a story we're tracking today. Earnings reaction there, 47% jump in profit, shaking off the early cobwebs, and we're up now 2.4% on the stock, 413.20. That's ahead of some key earnings coming through today. Out of likes of JD.com, JD Logistics, Geely. Billy's also out with earnings as well later today. From equity markets to the FX space, where we're seeing also some movement here. So we talked about copper already earlier on. The 30-year JGB yield is now at a high since 2010, and you were mentioning this earlier. The dollar strength continues to show up in markets today.
It's King Dollar, and it's what we're hearing from Barclays at the top. It's going to be sort of the dominant factor that comes cross assets. And again, you're seeing that expressed because, yes, the two stories, you've got that Fed cut pretty much baked in for December, it seems, or greater odds than we had earlier this week. That leads to expectations that, you continue to see that dollar strength. Concerns around China's economy, that leads back into the US exceptionalism story, and that's really just playing out across markets. Yeah,
and you express that, I guess, through US exceptionalism is the cleanest read for that. Markets across the Asia Pacific and China, we're flat right now, 30 minutes into the session. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI a half hour into the session this morning. Of course, let's just start off with really what's the big story today for Hong Kong traders. This is the first T8 that we've ever had in the city where traders are actually being called into the office. We no longer have trading suspended during T8 signals, so sorry to all of those who are in their office positions today. We're here as well. We do have that strong wind signal that's going to come in at 10:20 a.m., so in about 20 minutes from now. That's the story there. But in terms of the equity markets, we have seen them sort of pulling back from the lows of the day. They're still in negative territory and under pressure. And I think something else worth pointing out is just that trading volumes are a little bit weaker today. So maybe there's still a bit of a lack of conviction, perhaps?
Into the bounce of the low. I mean, the typhoon of the stronger dollar, just to bring in that analogy too, is continuing to make itself felt across markets in the region here. So the Hang Seng Index, as we were pointing out, opened lower, bounced into slightly a couple of minutes into positive terrain, and has since the last few minutes or so pulled back a little bit as well. And that's, it's a similar story across, as Belle was pointing out, just about across the region, right? So since the U.S. elections, the strong dollar story, the strong Bitcoin story has really played out. We'll show you the Japanese yen a bit later on, but a couple of markets in the region are entered a correction this week. You have the Philippines, which fell 10% from its peak yesterday. It's down a further 1.25 today. India entered a correction also yesterday, and the 200-day moving average is going to be very much in focus, and whether that specific level holds. On the Nifty index, the Kospi, by the way, is currently about 5% from a bear market with a bounce today. Of course, this market opened up an hour later because of the college entrance exams. The rest of the region, Asia, as we were pointing out here, some headwinds coming through because of the strong dollar, which is the third ticker you see on your screen. So Bloomberg Dollar Index is up again, 0.1%. Dollar yen, rightmost side, first row to your right. We're now trading closer to 156 than 155. So that's a fourth day of weakness in the Japanese currency. And, in fact, on the strong dollar story, we asked this question to the head of cross assets at Barclays and whether or not this U.S. exceptionalism theme will and can continue to weigh on assets. Have a listen.
For now, the broad dollar higher theme is really what's been driving risk in the region across FX and equities, and we see that continuing. We're looking at euro at 1.04. We think dollar CNY goes to 735 and then 750 by end of next year. Dollar yen, we think, goes to 158 before settling in again around 155 levels by end of next year. So for now, U.S. exceptionalism continues from our perspective, and the broad dollar higher channel impacts Asia immediately.
And if there's anything that sort of cemented that strong dollar story, it was really the inflation figures out overnight as well, because we saw it sort of coming in line with what headline estimates had been, but it tells us that so-called last mile of inflation, it's going to be a bit difficult to get down to that sort of target level. And so that Fed rate cut is certainly in the cards for December. Questions around where we go for next year, but still it's that dollar dominance theme that remains intact.
It certainly is. And, the Fed, I think we have a great story which I guess in many ways summarizes this debate within the Fed that they do want to cut rates. They probably will in December. But to what extent can they actually normalize policy, which is they acknowledge is still restrictive, going into next year? And that is keeping really the dollar as the cleanest read as far as that's concerned. In fact, I think we did hear from, Neil Kashkari. I think we have that soundbite to play for our viewers. Let's split it out, guys, please. Oh, do we don't have it? Okay. What did he say, though? To paraphrase, I think we're nearing, he's confident, and I'm paraphrasing from memory, he's confident that they're going to near 2% on inflation, but any nasty surprise on inflation ahead of the December meeting might make him rethink, I think, backing a cut.
But he did confirm that inflation is heading to the 2% mark.
Yeah,
that was sort of the overall takeaway from the interview. We actually just spoke to him just minutes after the release of the October readings, so emphasising as well that he hadn't actually been able to dig into all of the details yet. But yeah, Fed officials definitely have been a little bit caught in two minds on this one, it seems.
Yeah, well, it's good they're data dependent more than anything. Mark Cranfield is with us right now to help us make sense of this. Mark, our MLife strategist, joining us out of Thailand today. Mark, equity markets were down a quarter, 1%. Your thoughts on how long this strong dollar story can and will continue?
Well, it would be surprising if it didn't run at least through to the inauguration of the next president in January. That's a pretty likely scenario, and that would tie in with the kind of things that we've seen in previous cycles. So that's probably quite likely. What is interesting, you talk about the Federal Reserve there, because in the December meeting, what investors are also looking for is it's quite possible we'll get another revision in the Fed dot plots, which up until when they were redone in September, it had a pretty aggressive trajectory for where interest rates are going to go in 2025 and 2026. But given that the circumstances have changed now, that we would expect the next administration in the United States most likely to be pretty aggressive on fiscal spending. Potentially there's inflationary impacts as well. And as you say, the CPI data was a bit sticky. The core inflation is still well above 3%. That gives the Federal Reserve an opportunity to readjust the outlook with those dot plots in December. So they may well go ahead with a rate cut, but they may give a completely different outlook for 2025 and 2026. And that is what investors are beginning to see. That's why we're repricing some of the curves in terms of derivatives. And that's obviously helping to support the US dollar as well. So you're getting it in a double whammy, really, where there's potential for the Fed not to be as dovish in the years ahead, and for the American economy to remain pretty strong, because it's going to get boosts from lower taxes probably and fiscal spending as well. So it's all feeding in to a strong dollar story. There will come at some point, there'll be a pushback from other people. Obviously, Japan itself most likely will at some stage try and support the yen. Probably even China will support their currency. But for the time being, it's a trend which traders are happy with. And you can see positioning is pretty much, very much in favor of the dollar staying stronger for longer.
Mark, yeah, can I pick up on the yen point there? this could have more room to run, as you point out. At what point do you think traders should be thinking about intervention risk, or you know, how real that threat is, given how far yields in Japan have picked up, and certainly pricing around, you know, the BOJ might move in December? Who knows, Mark?
What's making it more complicated, as you say, is the Bank of Japan situation. So why intervention was so successful in July was because you had actual intervention around the 160 level, but you also had a rate hike from the Bank of Japan as well. So investors saw it from both sides. Traders were absolutely convinced that the Japanese authorities were all on the same page. They were tightening policy and they were intervening. So you have a successful round of yen buying. That is not necessarily the case yet. What we haven't seen, of course, the Japanese authorities came under some criticism for their meltdown in financial markets in August when the Japanese stock market plunged so much. So a much more cautious approach from the Bank of Japan since then, which they're not yet convincing investors that they will hike again in December. In fact, it's beginning to look more like next year. So from the Bank of Japan side, it's not so clear. And at the same time, the strength in the US dollar, again, is a relatively new, it's not just yen. The dollar is strong against everything. It's not pushing a single currency. All currencies are retreating. Look at the euro, it's down to 105, and people are talking about parity. So dollar strength is not singling out one person. It's all currencies are on the back foot against the US dollar.
Some, Mark, though, in the FX space look a little bit more vulnerable than others. And the Thai baht, I know that you're in Thailand right now, but it does look like it could be more exposed.
You would expect most Asian currencies, if the Chinese yuan stays weak, most of the countries that trade with it would adjust their currencies accordingly. So whether it's Korea, Malaysia, Thailand, you would expect all of them to adjust. The added problem for the Thai baht is that investors can see that the government has been interfering verbally in terms of what they expect the Bank of Thailand to do. Now, when there's a disconnect between what the government is doing and what the central bank is doing, investors will leap on that quite quickly. They will push the currency lower because they don't think everybody is on the same page. And until Thailand can convince everybody that the government and the central bank is all moving in the same direction, there will probably be a discount for the Thai baht compared to some of its regional peers.
Yeah, and we were just seeing there, Mark, on a 5-day basis, the Thai baht, the worst performing currency in the Asian FX space. But that was our Bloomberg MLI strategist, Mark Cranfield, there in Bangkok. And coming up on the China show, we're going to go back to the Barclays Asia Forum in Singapore, where we have an exclusive interview with the bank's president and head of investment bank management. That's next. And this is Bloomberg. Let's head back to the Barclays Asia Forum in Singapore, where Haslinda Amin is standing by with our next guest, Has.
That's right. It's about markets, it's about Trump, it's about China. Stephen Dainton, head of investment bank management at Barclays, joins me now. Good to have you with us.
Thank you.
When we last spoke in April, we talked about how it was flight from risk. It's a different situation. Now you just can't stop the momentum.
No, you're in an amazing environment for risk assets right now. And thank you for having me here at the 18th Barclays Asia Forum here in Singapore. We have 1,000 people here to discuss exactly these issues. But I think what you've seen clearly post-Trump, Trump's election, when not only in the White House, but in Congress and the Senate, is clarity of U.S. political direction. And I think risk assets are accreting towards that clarity. And I think over the course of the next 8 weeks, as we move towards the end of the year, there is likelihood that you see those risk assets squeeze up, even though you, as you allude to, you're at very elevated levels of risk in equity markets, in credit markets. So I think that will continue into year end.
Is the market underpricing risk? Yes, inflation is easing, but still very sticky. Yes, we have growth, but it is slowing down. I mean, might the markets be underpricing risk right now?
I think there is a very good chance it's underpricing risk. And perhaps the greatest risk is sticky inflation, as you've highlighted. If you have higher for longer, I mean, it's extraordinary. We've been in an environment with interest rates in the US of north of 5%. And yet the US economy has managed to grow in 3 consecutive quarters at a level that, candidly, I would have been really shocked at. So you are seeing financial markets accrete towards finding growth. Growth, by the way, is being exhibited very clearly in the US. It's being exhibited very clearly in Southeast Asia. And yet it's not being exhibited in Europe. So I think there's a big dispersion of where economies are finding growth. But as you've highlighted, I think the single largest risk for financial markets is a continuation of inflation. How sticky is inflation? How long it remains an issue in Western markets in particular. And I think as you look into the Fed direction in Q1 and Q2 of next year, it will be the single largest issue alongside the fiscal deficit.
We talk about momentum, yet there's one person who's actually exercising caution. Warren Buffett, taking money off the table, more than $300 billion, sitting on the sidelines, waiting for an opportunity. He says, you know what, there's nothing to buy right now. Maybe he knows something we don't. I mean, is it time to take money off the table when there is herd mentality, when people are just buying and buying?
There is no doubt. I mean, you have someone who is the world's greatest investor acknowledging the elevated level of risk. Having said that, as you look at some of the performance of the major world indices during the course of this year, and most of the world's indices, equity indices, are trading at highs for the year, that is going to put a lot of pressure into year-end on a number of our clients as they seek to perform into the end of the year. Without doubt, you will see as you pass through that calendar an element of awareness of the risk parameters in front of you. That becomes very focused on 2 things. That is the path of major central banks. And secondly, the growth aspirations of the US versus Europe versus Asia. So those 2 very particular things become the myopic focus of markets, I think, very early in the new year.
We talked about how the bond vigilantes have been awakened when you take a look at where yields are right now. I mean, the U.S. deficit is not a problem until it becomes a problem. When do you think it will become a problem and hurt sentiment?
Well, I think the president-elect has 1 term, which is important. So undoubtedly, the U.S. administration is going to be very focused on that 4 years on implementation. In fact, they're going to be focused most likely on 2 years because obviously you have House votes in 2 years. So with the House, the Senate, and the White House aligned, you're going to have a 2-year period where U.S. policy and U.S. policy direction will be implemented most likely very quickly. It is likely that the first year is not focused on the deficit. The first year will be focused on how the U.S. grows, a change in direction in energy, of course, and I think addressing some of the big issues that the world is facing, implementation of AI, decarbonization journey. So I think you'll see a number of policy implementation that comes in the first 2 years. I'm not sure the first year is going to be focused on the deficit.
Earlier, you talked about how there's greater clarity now that Trump has won. We're quite clear as well in terms of what his policies might bring. The impact, though, is still a question mark for countries like China. How are you assessing the attractiveness of the Chinese market? Yes, they say valuations are low, but they're low for a reason.
I think we cannot underestimate China is such an enormously important economic power, despite the travails of the last 2-3 years. What I think you will see is those 2 very material leaders enter a dialogue. I mean, obviously, we have to walk through the tariff journey, whether or not it reaches 60% for Chinese goods. I just don't know. But I do think it will be a process of bringing 2 very substantial world leaders together to enter a dialogue. And we all know that President-elect is a negotiator. And I think that will be something that we see. Importantly, you will see them come together to talk. Both have to find growth. Both have to find growth. And I think when you look at the parameters of growth, China, Asia versus the US, the person right in the middle is Europe. And I think Europe also needs to find a pathway of coming together with a vision for a collective Europe that also finds a growth path, because that is sorely missing. And in Europe, you have a lot of political issues with France political change, German political change. And interestingly, when you look at the countries in Europe, what you have is Greece and Italy looking like the countries that are managing to grow the quickest, which you might not have said in the immediate aftermath of the GFC, but it is because they have restructured and they have restructured quickly.
You talked about finding growth, and China is finding it difficult to find that growth. We have stimulus, but that stimulus is not quite playing out in the economy just yet. Some say perhaps in the middle of next year. Where do you see China finding growth, and what is sustainable growth for China now?
I think you've got China growth at around 5%. If that establishes itself as sustainable, that is manageable. But I think what it also has to do is restructure. And the stimulus packages that we've seen have been somewhat inconsistent. And I do think that you'll see a more consistent pathway once the two premiers have established a dialogue. So both sides actually understand what they're dealing with. And from that, I think you'll see a far greater response from China once they actually understand the mosaic and the puzzle that they're dealing with. All of this, I would say, though, that I think that there is a high likelihood that you enter a period of very active capital markets. I do think when you look at the valuations in the US, it is likely that the process of M&A begins to get underway. So I do think that over the course of the next 12 months, you'll see a rich capital market environment.
And how do you see China markets coming back? I mean, we're seeing the exit of foreign funds, for instance. What would it take for them to come back? Increasingly, playing emerging markets ex-China has become the thing for a lot of funds.
Well, look, I mean, you've got India has grown enormously in the last decade. India's demographic growth, its GDP growth, the scale of India, its position on the world stage has become extraordinary. So I think you have Southeast Asian economies in Vietnam, in Thailand, in Indonesia, Malaysia, all exhibiting growth. But I do think if you see China restructure over the course of the next 12 months, once they understand the clarity of the pathway with that dialogue with the US, I think there is a very good chance that risk assets in China become extremely interesting.
Do you envision a time when investors can play emerging markets without China, or China will have to be part of it, given that it is the second largest economy?
I think people are already very active in risk assets outside of China. I mean, Southeast Asia, Australia, India, as I mentioned earlier, the liquidity in those markets has improved dramatically in the last 3 or 4 years. It doesn't mean that it is entirely liquid. But what you have seen in both credit markets and in equity markets is a heightened level of liquidity, allowing foreign access. And most of these countries are looking for foreign capital. FDI across that portfolio in particular, including India, is vast.
As we inch closer to a new year, 2025, I mean, how should the positioning be for investors, and what's the biggest risk?
I'm a big mean reversion person, so I look at the assets that have underperformed. In particular, Europe has underperformed, although if I look at the performance of the German index, equity index, or the Italian index, they perform very well. I think restructuring in Europe is a must for next year. I think that's a substantial advantage. I think a period of M&A and restructuring will accrete assets into Europe if you have a clear path. You cannot get away from the fact that America continues to exhibit exceptionalism in everything. It is a technology superpower. It is an energy superpower. And I think once you see the pathway of policy in the US will continue to be a major driver of risk assets. Credit itself, private credit growth in the US has been extraordinary in the course of the last 2 or 3 years. That is seeping its way into other economies. But I think these asset classes will continue to grow enormously. Everything has to find growth.
All right, Stephen, thank you so much for your time today, your insights. Stephen Dainton, Barclays president and head of investment bank management. And Dave, it's back to you.
Yeah. Haz, catch your breath, get a water. We'll be back with Haz in a couple of minutes there with her next guest. As the conversation was taking place, a live market update right now, weather update to be more specific here in Hong Kong. You know what? I've always wanted to be a weather reporter, never wanted to be a financial journalist. This is by accident. That's a true story. Anyway, the Hong Kong Observatory has now lowered the typhoon or the wind signal to 3 from 8, although they say strong winds are still blowing. Please do not relax taking precautions. It is not safe for small vessels to leave these typhoon shelters to take apart from that statement. Plenty more ahead. This is Bloomberg.
Welcome back. A look at some of the top global headlines this morning, and a close aide to Israeli Prime Minister Benjamin Netanyahu has reportedly told President-elect Donald Trump that Israel is rushing to advance a ceasefire deal in Lebanon. The Washington Post says Minister of Strategic Affairs Ron Dermer visited Trump's Mar-a-Lago compound last weekend before going to the White House. An Israeli official told the Post there will be an understanding on Lebanon by January as a gift to the incoming president. Ukraine's allies are planning to pressure China at next week's G20 summit over North Korea's support for Russia's war that's growing as well. Sources say one group of 7 nations believes Beijing is unlikely to be pleased with Vladimir Putin and Kim Jong-un's alliance. The allies also are seen as deepening cooperation affecting the security balance in the Indo-Pacific. The US says China's state-sponsored hackers have perpetrated a broad and significant cyber espionage campaign. Officials say multiple telecom companies were infiltrated to steal customer call records and compromise communications belonging to some people in government and politics. The New York Times has reported that the targets included Donald Trump, J.D. Vance, and members of Kamala Harris's campaign staff.
Right. Earnings are a key theme today. So Tencent was out, earnings reaction there, as well as Samsonite. The two others, of course, are coming out with earnings later today.
It's 11:29 a.m. in Tokyo. Japanese traders 1 minute to go until they're on their lunch break this morning, and it's pretty positive, the mood. I mean, we're sitting fairly flat now, but parts of the market are moving higher. And one of those subsectors, well, there's firstly what's happening in the yield space, but also let's talk about the banks, because they have been moving higher, really leading that advance in the session today. But it's a couple of different themes that are driving that, because, yes, firstly, in the bond space, you've seen Japanese yields climbing, and so then that's supporting financial stocks in the near term. And then in addition, you've got those moves around the Japanese yen, and we have seen sort of further weakness coming through. It's that story of dollar strength, but it does, of course, help the exporting names. Big earnings week as well, and MUFJ is going to be out later today. Possibly couldn't keep that positive mood going in Japanese mega banks, given we have actually seen it managing to beat its estimates for each of the past 5 reporting periods.
Yeah, and you know, this is really a way that has been almost a second derivative of, if you wanted to ride the strong dollar story in Asia, it was an index play in Japan, I guess, and to some extent the Japan banks play, because then you have a two-factor push there along with higher yields. So now I think we're about 3% away from the peak that we hit on the Topics Banks Index that we hit right before the market crashed because of the carry trade unwind. So we're at 3% of that level. The rest of the region, though, to the point we were making on this maybe hedge against the dollar, is, broadly speaking, we're down across the benchmark. The strong dollar is continuing to show itself, 1285 right down the Bloomberg Dollar Index. And most sectors, as you can see on your screens, are actually trading lower here in the Asia-Pacific.
Yeah, and you can sort of add to that the weakness that we see in some of the China tech earnings as well, because Tencent is one of the notable laggards today in the session so far. Actually, we did see it turning positive, but anyway, we'll keep tracking it. Let's head back now to the Barclays Asia Forum in Singapore. Haslinda Amin is standing by, has lots of guests throughout the day, but you've got another one by your side right now.
That's right, Belle. And of course, the world digesting the nominations for Trump's cabinet. What might that mean for Asia? Joining us, Ruchir Sharma, chairman at Rockefeller International. Ruchir, good to have you with us.
Thanks for having us.
Well, it does seem like the White House biggest disruptor is back. Be nervous, be very nervous. Is that a fair assumption to be making?
Yeah, but I think that, what's really remarkable is that the rest of the world seems much more nervous than America does. If you just look at the investment trends that have followed the election, that the U.S. outperformance, if you look at stocks, the dollar, versus the rest of the world was already very stretched going into this election. And after that election, it's become even more stretched. You have this incredible situation today where the US stock market, if you look at the global MSCI index, is approaching 70% of that index. We've never had a situation like this before. And so I think that what the market is trying to sort of tell you here is that America will be fine under Trump, but the rest of the world is going to suffer disproportionately. And I think that that, to me, seems like a real overreaction, that everything Trump does will be great for America, will be terrible for the rest of the world. It just seems like that is a bit of an overreaction to me.
Why not? I mean, Trump did say that he wants to make America great again. It is America First policy. It would be.
Yeah, but like in terms of if he's to truly disrupt, right, in terms of the fact, then even market trends will need to change from what we saw under Biden. Under Biden, what did we see? We saw the US stock market surge led by mega cap tech companies. We saw momentum strategies do very well. We saw the dollar also strengthen a lot. So I find it very hard to believe that you're looking for Trump to be a big disruptor and change things, and yet the market playbook will be exactly the same or roughly the same as was under Biden. It never really works out that way. So I think that this is too early to tell in terms of what's going to happen. But I think that this trend where you think that everything that Trump's going to do is going to be great for America because what he says, the slogan matches that, and will be terrible for the rest of the world, I'd say that there is some sort of a contrarian case to be made for this, unless you believe that contrarian investing is dead and momentum will just keep on running this way.
We'll pick up on the contrarian trade, but for now, though, I mean, we've seen how the MEC 7 has been driving that rally.
Exactly.
And Trump represents an easing of regulation, which would benefit the MEC 7 and other tech plays. So how should that playbook look like?
Not really, because one of the themes that I've argued for in the past is that under Biden, you had incredible amount of increase in regulation. And you've had that pattern for the last 20, 30 years in America. And that increase in regulation typically benefits big corporations because they're able to afford those regulations, and they're also able to influence the way the regulations are written, given their lobbying power in Washington. It hurts small and mid-sized businesses. So under a true deregulatory environment, it should help small to mid-sized businesses and not the MAG 7 and the big corporations. If anything, if you looked at the statements before the election from people like J.D. Vance, they in fact were quite supportive of antitrust action against the MAG 7. So I think that that's exactly my point, that we can't have it both ways. You can't be looking for Trump to be a big disruptor and for that to come through, and yet the investment trends that were true under Biden to continue rolling on, which is what the market's currently broadly doing with the re-election of Trump.
That takes us nicely to that contrarian trade you were talking about. How does that look like?
Well, as I said, that the U.S. outperformance versus the rest of the world has never been this extreme in history. That the U.S. has been more expensive as a stock market, like we saw in 99, 2000. The nuttiness was even more, you can argue there, in terms of what happened, that a lot of companies without earnings were flying at the back of the tech boom then compared to now. But the U.S. outperformance of the rest of the world has never been this extreme. It's almost become a zero-sum game, that when the U.S. goes up, you feel compelled to sell the rest of the world down. And I think that a lot of good stories in the rest of the world are being sold at the same time, just because you're so scared of the U.S. outperformance continuing. The momentum strategies are even more powerful. So what the contrarian trade would look like for the next few years is that the rest of the world, in fact, ends up doing better than what America does. And there could be an important trigger for this, which is that today, the world thinks that America can run whatever budget deficit it wants. It has the world's reserve currency, and all warnings in the past about debt and deficits in America have proven to be crying wolf. Eventually, the wolf did arrive. And my suspicion is the fact that over the next few months, that you will see increased focus on the American deficit, just because now it is such an outlier. There is no other OECD country running a deficit like America is running. Its debt trajectory is on path to overtake that of Italy now and just be behind that of Japan by the end of this decade. So these are very serious metrics, and Trump has no intention, from what I can make out, of really paying any attention to that. So I think that that's going to be the key, that when does the world's attention turn to America's debt and deficits. It could come sooner rather than later. And that could be the trigger for people saying, hang on, we just can't keep on putting all this money into America. We still need to think about other geographies in the world.
Well, in our early conversations, they say that, that talk of American deficit will not come in the next 12 months at least. So you're predicting perhaps earlier rather than later.
Yeah.
You talked about how the rest of the world could grow faster than anticipated. I mean, it's not blanket, correct? I mean, Europe is struggling.
Yes.
It's trying to find growth. Perhaps it is Asia where money should be chasing.
Yeah, in terms of that. And the ironical thing is, that's is the fact that some of the markets which have been sold down the most after Trump's victory, very short term, have been some of these ASEAN markets and stuff which were otherwise doing relatively well. But I think that there's no liquidity in these places. So even small amount of selling has a disproportionate effect on prices. But when it turns around, the opposite can happen. So yes, I think that Europe is just a value case. There's no growth there. There are enough stories I can find around the emerging market world where there's both value and growth. US has some growth, but it is extremely expensive. So I think that we just need to sort of find the middle ground. Where can you get growth at a reasonable price around the world? And there are many emerging markets, whether it's the ASEAN markets, Eastern Europe, or even some really beaten down countries in Latin America where you can find that. And I think that we need to think about those. But today, nobody wants to touch those markets because everyone is so obsessed with what's happening in the US, and they're allocating all the capital they have at the margin to the US, thinking the dollar is only going to keep strengthening from here.
All right, watch out. Ruchir, thank you so much for that. Ruchir Sharma, chairman at Rockefeller International. Of course, we're coming to you from the Barclays Asia Forum. Our coverage continues. Dave.
Yeah, but Will, if you think Has was finished, you look at the guest lineup in the next hour, certainly that will tell you that she is not finished. And we were talking about this Kerry conversation. There's another Kerry conversation coming up there out of Singapore. Our guest coming through in the next hour of Bloomberg TV from the Barclays Asia Forum on your screens at those times for you there. All right, let's move things along, and maybe with the John Kerry conversation, perfect segue to talk about geopolitics now, Bill.
Yeah, that's right. We just actually had some lines dropping that President Biden will be meeting with Peru's president on Friday. He's going to be, of course, traveling to Peru and also to Brazil this coming weekend. It's the APEC summit that's going to be underway, and lots of different global leaders gathering. Most notably, it's going to be the third and also the final face-to-face meeting of the Biden era between Presidents Biden and Xi Jinping from China, of course. Let's get more on that now with our China correspondent, Min Min Lo. And Min Min, what exactly can we expect from this meeting, given it, as we said, it's the third, but it's also the last?
Yeah, it is. I mean, it's about exactly 1 year from the last meeting they had, also at the same event, the sidelines of the APEC summit last year back in San Francisco. But this time, obviously, Biden is just a couple of months away from the end of his term. He's essentially in this lame duck period. So it's not a typical meeting where you have, a laundry list of deliverables. It's more of a meeting for the two sides to reflect on their relationship over the past more than a decade or so, really ever since Biden became vice president under Obama. And he's likely to highlight again that repeated message that he's been saying again and again, the importance of this open line of communication between Washington and Beijing, especially during this period of presidential transition. He's also likely to highlight some of the issues of concerns, as you mentioned earlier, that alleged hacking into the U.S. telecommunications network, as well as what Washington sees as Beijing's support for Russia. And on the flip side, President Xi likely will want to get a hint of what Trump's policies will be like, but it's not clear that he will get that much clarity from this meeting with Biden.
Apart from the meeting, what else is on the agenda for the Chinese president?
Yeah, so obviously he's going to give this very important speech, which the Chinese Foreign Ministry has said is going to be around the theme of deepening reform and opening up. So again, this importance of free trade against this backdrop of increasing protectionism from the likes of the US and the EU. And of course, he's also going to be making a pitch. He's on this 9 days trip to Peru and Brazil. So he will be meeting with President Lula of Brazil, discussing deals, potential investment for infrastructure in Brazil. He's going to be signing an updated free trade agreement with Peru, inaugurating this $1.3 billion port in Peru that eventually is going to be able to handle some of the biggest ships traveling between South America and Asia. So again, all part of this effort to prepare for the eventual reconfiguration of this global supply chain in anticipation of those Trump tariffs.
Yeah, and actually, Min Min, to your point, that was our China correspondent, Min Min Lo there, to the point just making around sort of that deepening relationship we see between China and the global south. A topic of the big take today as well, because we have seen that embrace of the Brazilian president toward Beijing, looking at it to help with the country's economic developments. That's a strategy that, of course, risks a sort of run-in with President Trump when he takes the White House. But you can get that on the terminal or on our website. We'll have more ahead. This is Bloomberg.
Good morning. Welcome back. You're watching the China Show. About an hour or so into the cash market session here. Hang Seng Index, we're looking at that. We're just as we can see. Can we move that cursor so I can see the points staying on the screen? So the Tencent story is actually holding this one up. So we're down 155 points. We would be down about 200 if it wasn't for Tencent, and arguably 200 takes you back now to the week of September 26, which is when the PBOC came out with a live briefing and signaled that major policy pivot. We did break support, and we'll see whether or not this Tencent and tomorrow's Alibaba story can keep things afloat while markets wait for the next catalyst here.
You know what, Dave? I think you're really putting a lot of pressure on these companies.
They better deliver.
Yeah, 10 cents high today, but it's kind of interesting because it dropped on Wall Street overnight. So the ADRs actually had told us maybe it could drop around 2%. There's the near-term strength in the company, and we saw that in the gaming division. But you look at a bit longer, and there's certainly some concerns that even the executives are talking about on the analyst call around the longer-term economic outlook and how that's expressed in key business divisions, particularly the fintech one, advertising arm as well. But let's get more with our Bloomberg Intelligence senior analyst, Robert Lee. And Robert, I know you're not that keen to talk about why we're seeing the stock trading high today. So maybe just start with what stood out to you in the numbers.
No, I will answer that. I think, there is a typhoon signal late here in Hong Kong. It's early days. Volume is a bit thin. We'll see where the stock closes. But I would say one thing on the results call last night. I wouldn't call the tone of management downbeat in any way, but it was sort of lacking in vigour. You think, compare and contrast to someone like Tim Cook, this is the greatest phone we've ever produced. It's all really upbeat. There was a lack of strong messaging, and that was a view that both myself took from the call and several of my colleagues. But the numbers were solid. There was, it's hard to split hairs there, but it was well anticipated. There were no major surprises. There was no margin beat. And we did see incremental weakness coming through in the ads and fintech business, as I think we flagged beforehand. But I guess short-term stock price movements are normally driven by sentiment. On that front, I would say no, nothing new. But as you've said in your intro there, looking longer term, the earnings growth for this company is going to revert to the mean. They'll deliver roughly 10 to 12% earnings growth next year, and we have got incremental weakness coming through on two of their core divisions. So the risk profile of this company is increasing.
Well, speaking of next year, what do you think the biggest opportunities are for Tencent for them to be able to get 10 to 12%?
It's a very broadly based business, a well-diversified business. So on that front, whilst their risk profile relative to themselves is increasing, compare and contrast with the likes of Alibaba and the e-commerce plays, there's far less exposure to the consumer front or whatever. So you've got a good diversification of businesses, and I don't want to contradict what I've just said a few moments ago. But, as I've mentioned before, games, you're only as good as your next big hit. DNF Mobile has been a major driver of this year, and that has largely played out. So it's a bit of a mean reversion. For a company of this size and scale, 10 to 12% earnings growth, there is nothing embarrassing in that. But we are, at this point, unlikely to see the 30 to 40% growth that the company is due to deliver this year. Can I just say one other very quick thing?
Sure.
And this applies to all the internet companies. Obviously, coming out of lockdown, they really kept the lid on costs, and even many companies were reducing headcount and keeping costs under control. There's a lot of pent-up pressure being built up, and now we are seeing companies beginning to increase the costs again. So again, that's another issue that they have to deal with next year into a slowing economic environment.
Well, and I guess that points to the the intense competition we see on the AI front as well, because there's that sort of race for who can have the most dominant tool and who can integrate it the best, who can monetize it the best. How's Tencent going on this front?
Yeah, I think, to be fair to them, they're playing the long game. They've not rushed in. They've not tried to overplay their hand. I think ultimately within the Chinese AI sector, scale win out. So I think, they do stand to be a long-term winner. But because it's a hyper-competitive market with price wars in both the AI cloud sector and also the mainstream chatbot sector, all these companies, Tencent included, will struggle to monetize, and the sector as a whole will remain loss-making for the next 3 years. The way that they can capitalize in AI is really through applying it to drive efficiencies and cost savings within their business, particularly for sort of game development. So I think that will help them, support margins to some degree, but, it's not going to drive the top line, and we're not going to see a major benefit on the bottom line for many years to come, unfortunately.
Robert Lee, thank you so much. Our Bloomberg Intelligence senior analyst there on the 10-cent story, up 1.6% there in the cash market session. We'll leave you to look at the dollar story and the FX space. Somewhere in the world, someone is unfortunately flexing for a gym selfie. Also is the dollar, as you can see on your screens. This is Bloomberg.
Republicans are holding on to their narrow majority in the US House, giving Trump and his party unified control of the elected branches of government. The sweep will likely limit any potential curbs on the incoming president's power. That's expected to strengthen Trump's hand on immigration controls and tax and regulation cuts.
Yeah, and former US House Speaker Kevin McCarthy is actually hailing Trump's choices for key nominations to his cabinet, except for one. He spoke to us at the Barclays Asia Forum in Singapore.
I think choices are very good except one. Look, Gaetz won't get confirmed. Everybody knows that. But when you look at a Rubio, just the knowledge that he has, being in the Intel Committee, I was on the Gang of Eight, and his understanding, even when you listen to the other side of the aisle, they say, he'll make a great Secretary of State. So that's strong for me. A Waltz, just his background, from a Green Beret and others being the... But John Radcliffe at CIA, former DNI, that's very strong. And the difference is to what was 8 years ago today, President Trump understands the job. He knows the people that he needs around him to get there. And I think he's going to be much better prepared because he only has one term, but he'll hit the ground running this time.
You say Gaetz will not be confirmed. No. Why bother with the nomination then?
You can talk to the president, but it's a good...
How are you reading it?
It's a good deflection from others, but it also gives... I'll let it stand at that.
No, I mean, just provide us some thinking into, what Trump had in mind when he made that nomination. Is it a case of, you win some, lose some? It is a negotiating tactic? What is it?
You'd have to ask the president, but Gaetz couldn't win in a Republican conference, so it doesn't matter.
When you take a look at the nominations so far, I mean, we've seen, China hawks, for instance. Is that an indication of how he will approach the relationship between the U.S. and China?
Look, I think for those world leaders, they have a relationship with President Trump, and I think they're probably thankful that President Trump won. It brings greater stability around the world, but it also says a very clear message that America won't be pushed around. And also when it comes to economic issues like trade and others, this president wants to negotiate. This president wants to have a fair deal. And he can work with anybody, be it the leader of North Korea, and stop testing your missiles and let's sit down and talk. He's willing to sit down and talk to anyone. That's a different approach that I think is much more successful, and I think the world will approach that. Putin never invaded another country while President Trump was in office, and I think those things will stop as well.
Yeah, and that was just Linda earlier on with the former House Speaker Kevin McCarthy over at the Barclays Asia conference taking place in Singapore. More on that in a moment here. The market story, though, Belle, has really been this dollar strength story that's continuing to really show itself in a very big way here.
Yeah, well, we had the inflation figures coming out overnight, sort of at the headline level, pretty much meeting expectations, but it tells us that that expectation for the Fed cut in December is still intact, and so that really sets the scene for dollar strength. I think going back to what we heard there, though, from that sound with Kevin McCarthy also plays into the other major theme, which is that America First policy and how that has really led to that greater sense of US exceptionalism at the expense of certain markets and economies, possibly in this region as well. And that's playing into perhaps the FX trading.
Yeah, America First has really been also, I think, a marching order for global investors. Dollar strength continues. This is Bloomberg.